very easy to buy a property and turn it into an Airbnb and make it look really pretty, but it doesn't guarantee that it's going to cash flow.
Where do most people end up inevitably making mistakes?
It's losing their money. They're underwater. They can't get out of it. If they just understood the data, they'd be able to avoid that.
You're getting very attractive numbers, but how do you hedge for that recession that you seem to be very aware of the fact that it's going to come?
Is there even a shot for me to make $10,000 in free cash flow from this property? Or am I probably going to lose money? So this is where the 20% rule comes into play.
What exactly those steps are that you recommend people follow to avoid ending up with a not profitable investment? Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality. We essentially bring in here entrepreneurs, operators, property managers, and leaders in the space so they can tell us about their stories, their backgrounds, the lessons they've learned along the way, maybe even some of the mistakes they've made along the way, so you don't have to make those same mistakes yourself. I'm excited to be here with John Bianchi, the founder at STR Search. So, John, thank you so much for being here. Where are you based again? Just for the audience to know.
Appreciate you having me here. I'm up in Canada, about 2 hours away from Toronto. So more on the East Coast in comparison to the West Coast, which is the West Coast is much prettier up in Canada. It's where you get all the mountains and whatnot. But I do all my work over in the States. So every single last one of my clients is an American.
Awesome. So, John, before we get into your story, would you mind just telling us briefly about what STR Search is all about?
Sure thing. We are an Airbnb data consulting firm, and we are trying to be the absolute best when it comes to Airbnb data. That through educating other people and providing services surrounding around one idea. And that idea is that we want to ensure that nobody buys an unprofitable property, right? So it's very easy to buy an Airbnb, very easy to buy a property and turn it into an Airbnb and make it look really pretty, but it doesn't guarantee that it's going to cash flow. And if it's not cash flowing, why do you have it in the first place? Yes, there are tax advantages and things along those lines, but you don't have to buy a property that loses money, right? If you had a Subway and it lost money, you wouldn't keep it running. So an Airbnb is no different. And so I'm trying to do everything I can to ensure that nobody buys an unprofitable property again. And I do that through free education. So we have 6 free Airbnb data courses, and you can learn everything you need to learn. Okay. So end to end about property acquisition and how to understand the data. And just so you know why I feel credible to be able to speak about this is that I have helped identify at this point over 180 properties in the past 2 years. 120 of those are live, and we have a 100% success rate at finding cash flowing properties. So the process that I teach for free on my website is the exact process that I use to be able to identify all of those properties, right? Now, obviously, there's going to be some people out there that don't have the time or don't want to go through it themselves. And so those people have the option to hire us if they want to. And so that's how I built up my business, where it's like, here, you can do it, but you don't have to do it. You can have the option to hire me. And I always say I built my business out that way because I'm a really bad salesman. And so I could never convince people, you know what I mean, to hire me. But if they just had the option to hire me, they reach out and they hire me, right? It's like do it yourself or reach out. So that's what STR Search is. We're an Airbnb data consulting firm trying to be the best firm in the entire country and trying to ensure that nobody buys an unprofitable property again. And every single product, service, or free training that we put out there is guided around that general idea.
Love it, man. And so we'll touch on what exactly those steps are that you follow and recommend people follow to avoid, ending up with a not profitable investment. But before that, where does the concept come from, and what's your background, man? How do you get into this business?
So 2 different questions there, right? Where does that concept come from of trying to ensure nobody buys an unprofitable property? And then also, what's the background? I'll start off with why that's our mission, why we're trying to ensure that nobody buys an unprofitable property. And the reason being is because I've talked to too many people that have bought properties that are never going to make up a dime and that are losing them money. And it always bugged me to my core. Like it almost like breaks it feels weird to say, but genuinely like breaks my heart when I hear somebody tell me that they bought a property, it's losing them money, they're underwater, they can't get out of it, they spent $50,000 on furniture, they've managed it for 2 years, and all I'm thinking in my head is, if they just understood the data, they'd be able to avoid that. And there was a point in time where I had no free training out there, but I understood the process in my head and I knew how to find these properties myself. And I almost felt bad. I guess I did feel bad that I wasn't telling other people how to do it. And other people were using AirDNA and not knowing what to look for, not knowing how to avoid the mistakes, and making mistakes. And so it was just so clear to me that there needed to be something that was out there to help these people.
Hmm.
And there's this great quote, which is, if not you, then who? Which always kind of goes to say, it's on you, right? Like,
Hmm.
you know what I mean? The thing that you were best at, the thing that you were like born to do, the thing that you gravitate to, that you love, and you just naturally are better at it than most people. That's the thing that you should be trying to help other people with, or strive to improve, or whatever that may be, right? And so I kind of saw it as like this mission that we should try to solve, right? And so we're just continually trying to make that happen. Now, how I got to the point where I understood all of the Airbnb data really, really well, and I felt the confidence to be able to teach other people and work on that mission, is a longer story. So there's a little bit more to it. But I used to be a financial advisor before. I was always a guy who wanted to start a business. I just have this business mind where I'm constantly looking at things and wondering how it could be optimized and turned into a business and help more people, or whatever it may be. And when I was younger, the business that you could get into where you didn't have to have any capital up front to start was a financial advisor business, because you build the business client by client.
Hmm.
And from the age of 21 to 24, I built up that business to, well over 200 clients, had a business partner, had my own assistant, had my name on the door, was managing over $10 million. My business partner was managing over $90 million. And I hated it. I genuinely did not enjoy it even a little bit. And I felt extremely grateful that I was at such a young age where I knew that this was not going to be the thing for me. And I could
Hmm.
walk away with it before I had so many commitments that it was going to be impossible to walk away from. So once I understood that, it was a matter of trying to find the next best thing, right? The thing that I thought was going to hit all of my needs and whatnot. And funny enough, it turned out to be Airbnb, which is, to most people who are business owners, or like classic business owners, right? They hear that and they're like, Airbnb, you go from a financial advisor managing all this stuff to like Airbnbs, right? It just doesn't line up in their head. But there was something about Airbnbs. I started renting out my spare bedroom, and it was such an easy thing to do. I enjoyed the interactions. I was covering my rent. I was like, there's something here, right? And then I started really like diving deep into it and learned that, yeah, there's a whole business model here, and then there's data that you can use to be able to make sure you don't lose money. And so this combination of really wanting out of what I was doing, having the ability to get into this Airbnb thing and be able to scale it, and a lot of other factors led me to like sell off that business that I had and just go all in on this Airbnb thing. And I never grew it to a massive business by any means. I got about 15 Airbnbs out of Chicago, a couple down in Scottsdale. I had a couple over in Michigan at one point as well.
By the way, these are
And
properties that you acquired or properties that you were managing or doing
so I
arbitrage
had a
with?
Yeah, great question. Sorry, I always forget to clarify that one. Rental arbitrage, property management, and a cleaning company. So I
Hmm.
wasn't actually owning any of them at the time. The goal was always to get to that point.
Hmm.
You can't really own. It's really difficult to buy properties in Chicago and make them work as short-term rentals because of the regulations. So
Hmm. Hmm.
regardless, it was it's a learning process, a learning curve. If I could go back, I would only focus on purchasing. Right, I'd do all of the effort that I could to make sure I was doing purchasing.
Hmm.
But really, rental arbitrage and property management allows you to gain so much knowledge around Airbnb without having to buy the property, right?
Yeah.
So it's a fast way to scale. Anyways, with that being said, COVID came around, wiped that out, and it sort of just killed the business very, very quickly. I was luckily enough able to sell off the contracts that I had to somebody else. That was kind of a shit show of an experience as well. Learned a lot there. But at the end of the day, what I realized was that the one thing I did best was understanding the data to find the best possible properties to acquire, or to rent, right? Or to manage, or whatever it may be. And I realized it because of the amount of people I talked to who were just kind of like shell shocked by the numbers I was telling them, right?
Hmm.
And they're like, "What do you like?" Even gurus that were selling courses couldn't believe the numbers I was sharing, right? They're
Hmm.
like, "How did you do that?" And I'm like, I did this process, and they kind of got lost in the way I was explaining it. And so what ended up happening was I had so many people reach out to me for help. They just happened to hear, like, I'd help out one guy and he would tell three people, and I'd help out another person, he'd tell another three people. And then all of a sudden I started getting all these people reaching out. And I'm like, I think there's a business here, right? Like, I think there's a need in the market for something like this.
Mhm.
And I'm wondering how I could turn it into a business. And it really did take, a while to turn into what it is today, naturally, like any business, right? But after that point, I ended up getting a contract with the largest short-term rental investment fund in America. At the time, they were not the largest, but they became the largest over the last 2 years, which is TechVestor.
Which we had on
Acted
the
as
show
their
as well, by the way.
Have you? Yeah. Have you? There you go.
Yes.
Okay. And so yeah, so it was my job to identify what market do we go into and why. What property do we get within those markets and why? And then how do we optimize those listings to be extremely profitable, right? And so just using all of the data that I had available and the process that I had used for rental arbitrage and property management, kind of brought that all together when it came to purchasing, to prove to myself that I knew what I was doing. Honestly, like I wanted to prove to myself that this process actually worked. And looking back at it, I feel really good, right? Which is why I feel like I'm in a really good position, because we've bought in every single last property that we bought in is a cash flow positive property. So we have a 100% success rate with that process. And again, that process is free on the website. So
Mhm.
that's that's
That's great.
that's
That's
that's it. That's the whole thing. I said
that's
a
great.
lot there,
No,
but
no, no, that's amazing.
yeah,
So let's get into that process, and at a high level, and then we'll go into the specifics. But what are the steps that you identified in terms of what it's required to buy a profitable vacation rental property?
property. Yeah. So there's a ton of steps. There's a ton of steps, right?
Hmm.
The main course that I have out there is 40 hours long. And there's 5 other ones that kind of go along with that. Uh, but I can summarize it to the core things, right? The main thing that you need to understand is that you're not studying properties when you first get started. You're actually studying the market.
Hmm.
Okay. So what I mean by that is, the most common mistake that I see is somebody decides that they're going to buy a short-term rental, right? Their wife, them and their wife or whatever it may be, have decided, like, hey, we've saved up this money, let's put it towards Airbnb. I've heard a ton about this. Everyone online is saying it's the easiest thing in the world, blah, 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 blah. And so then they go to their lender and they go, hey, what kind of loan can we get to do this? And they go, you can get up to $500,000. We'll approve you for up to $500,000 to go buy a second home.
Hmm.
And so then they go, okay, let's go. What's our favorite vacation town? You go, it's that place that we've gone to 10 times. They go, what can we buy there for 500,000, right? And then they find a home that they talk to a realtor. Realtor goes, hey, that home's for 500,000. It'll do great, right? Realtors always say it'll do amazing. It's gonna be best. It's gonna be awesome. And they end up buying that home for 500,000 because that's how much they were approved for. And that was in the market that they were the most comfortable with. And the realtor's just going to facilitate the transaction, right?
Hmm.
And so that happens so often. You would not believe it. It is it's almost, and I'm obviously dumbing it down a bunch and
Hmm.
leaving out a ton of stuff, but the reality is, like, the overview idea is, like, that's what's happening. No matter how many questions that are asked and whatever they're going through, that's happening the most often, where people are failing the most in that exact scenario. And so the reason I start off by explaining that little scenario is because if they had just stopped, right? That couple, let's say, if they had just stopped and gone, let's actually take a look at every single Airbnb that's in the market that we're considering.
Hmm.
And let's try to understand why the ones that are making the most are making the most. And what do they look like? What is it about them that's allowing them to make more? And why would they make more, right? Like, why would one 4 bedroom make $100,000 more than another 4 bedroom? And
Hmm.
those numbers may sound insane, but it's real, right? There are 4 bedrooms, homes that are going to be the exact same size in the exact same market, and there could be $100,000 difference between the two, right?
Hmm.
And so you have to approach the market that you're going into with trying to understand what drives revenue for this market and why.
Hmm.
Is it pools? That's an easy one, right? Is it high ceilings? That's a hard one. But if you can review enough properties, you're going to start to see patterns. And so the way I always like to explain this is that all you're doing is you're trying to understand what the top performers have that the underperformers do not have. Those are the revenue drivers. Simple as that, right? And
Hmm.
the easier way to give a visual for this is, that game that you play as a kid where you have two images side by side and it's like spot the difference, but they're almost the exact same
Hmm.
image, but there's tiny little changes, right? That's what it's that exact game that you play, but with two Airbnbs. You play it with one that's making 200,000, another one's making 100,000. You go, what's the difference? And you can't just simply go, oh, it's a luxury one, that's why it's doing that much, right? It's like, no,
Hmm.
like really get into the nitty gritty detail. Look at the ones that are doing 120 compared to 100,000, because that $20,000 difference is all your profit, right?
Hmm.
And so you go, okay, well, what is the difference here? And if you can truly understand the difference by just playing that game in your head, you go, the revenue driver is having high ceilings with a game room that's large enough to be able to fit a pool table and a couch. And if I can do that and paint the walls in a specific color, they're going to attract kids because it's a game room. We want to make it a really fun environment for kids. The
Hmm.
parents are going to be willing to pay more for this property because it's a more desirable vacation property for their family. It's going to make them happier. So then, therefore, the parents are winning. And so, therefore, I'll make an additional $20,000 on this property in comparison to if I didn't do those things or didn't buy a property with a second living room that was large enough to facilitate that couch and that pool table, right? And so it's that level of just like taking it a little bit deeper to go, what am I missing here? Because if you don't do that, you may buy a property that doesn't have a second living room at
Hmm.
all. And
Hmm.
now you're trying to compete with the guy who's got an unreal game room in a family market, but you don't have a game room. And so now I've got let's say I had 3 kids and I'm going to go book an Airbnb. I'm going, well, I'm going to take that one that has a game room where the kids are going to go play for hours. And then me and my wife are going to go sit on the couch and watch a movie and kind of relax after a day of snowboarding or something
Hmm.
along those lines, right? And
Hmm.
so it's the very first thing, and again, there's many, 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 many steps to this, but the very first thing is just trying to logically understand what drives revenue within the market that you're in. Make sense?
That makes sense. And I guess what you're saying, going back to the example you were giving originally, is like, don't just use whatever amount you were qualified for, lending wise, and then just use that as, this is what I have to pay. You said no, start by studying the market. Now, that whole process you just described of understanding what drives revenue within a market assumes that the market has been identified already, right? what
Right.
about
Yeah.
what about identifying what that market should be in the first place? Like, what's the mistake that the other,
Yep.
example you gave earlier made, when they just said, oh, this is a market I'm comfortable with, therefore this is where I'm going to invest?
Yep. Exactly. And so this is where I want to go next, because this is the 20% rule. Right. So in the scenario I was just giving you there, they were dead set on that market because that's the vacation market that they grew up in and they want to get a vacation home there. Right.
Hmm.
That's the idea. But in before you do all this work to try to figure out what the revenue drivers are, you got to figure out, can can a property in this market even cash flow in the first place? Right. Like if I were to buy a property for 500,000 and I understood every single last revenue driver, is there even a shot for me to make, $10,000 in free cash flow from this property, 20,000, 30,000,
Hmm.
or am I probably going to lose money? Right. And so this is where the 20% rule comes into play. And it's a very general rule. I'll do my best to explain it, but it has been very helpful for me to be able to look into a market and find potential cash flow without spending a week studying a market.
Hmm.
Okay. So the idea is we are just simply looking for the purchase price compared to the revenue in a market. So if the purchase price of a property was 500,000 and the revenue potential of that property was 100,000, then it's very likely that that property is going to cash flow at an amount that I would be happy with. Okay? And I always have to state this, that I'm happy with the amount of cash flow that you get when you find a property that meets the 20% rule. If it
Hmm.
meets the 15% rule, that's fine. It's probably not going to cash flow as well. It might cash flow, might break even. You're kind of cutting it at the edge there. That's why I like to have that cushion around that 20% rule. Okay.
Hmm.
And so what you're doing here is, let's say you're that same couple. Okay. We're just going to stick with this scenario, and you got a vacation market that you grew up in and you want to go into it. And before you decide to buy the property, or before you decide to look into the revenue drivers, what you're going to do is you're going to look at what are the average properties doing in that market revenue wise. So you'll head over to airdna.co and you're going to type in that market, and you're going to take a look at the properties that are around the budget that you can afford. Okay. So this is the other thing here too. Like if you can only afford 500,000, don't be looking at the homes that cost 1 million and be like, oh, that's how much revenue I can expect from a property here. Try to get an idea of like, okay, a $500,000 home looks like this. Now, what does a $500,000 home look like on Airbnb, and how much is it making?
Hmm.
And when you can spot those two, okay, and you try and find a couple, maybe like 3 or 4 properties that all look like the homes that cost around 500,000, how much are they making?
Mhm.
Right. And then look at the good ones, look at the okay listings, maybe not as good photos, maybe not as good design. Get a really good feel for like what you could expect between the two and see what the price to rent ratio is. And if you can see that the $500,000 homes that you can purchase there are roughly making 100, maybe even 120 in that range, that's awesome. That is
Mhm.
exactly what you want to see, right? At that point, you add it to your checklist and you go, let's deep dive this market and let's understand what the revenue drivers are.
Mhm.
Okay.
Mhm.
However, if you do that exact same exercise and you realize that the $500,000 home you have over here can only make about 60,000 in this market, it's not going to cash flow. It's not really going to do what you need it to do, right?
Mhm.
And so therefore, you just got to be honest with yourself and say like, there's no point in me buying that property if I
Mhm.
want cash flow. If you don't want cash flow and you just want a leisure property that's in your favorite vacation town, this conversation isn't for you, right?
Mhm.
Like that's
Mhm.
not what we're doing here. We're trying to find cash flow. And so then that case, what I always say is just mark that market, like sorry, remove that market from your checklist and be
Mhm.
like, I'm not looking further into it. I don't need to know what the revenue drivers are. I can clearly see there's not enough revenue for this to work. So as an example, I live in a beach town in Canada. The homes cost anywhere from like 600 to $1 million, and the revenue potential on them is like 30,000 to 40,000, right?
Doesn't work.
Doesn't work. Not even a little bit. Maybe even if you could squeeze out fit 60,000, still isn't going to work, right?
Mhm.
And so it just is very clearly like I wish I could own Airbnbs in my own hometown, right? That would be amazing. I could go down the street and have 10 Airbnbs, they're all cash flowing for me. That'd be absolutely amazing. I'd be the happiest guy on earth and I would have probably half the town at this point if that was possible. But the reality is that like it just doesn't work out. So you have to go to a place where it does work out, right? And that's just how it goes. So yeah,
Yeah, yeah, yeah. No, that's very good. That's very good. It's very detailed and I think very practical as well. I love it. Now, a couple of things there. First is this idea of trying to look for properties that cash flow is at the center of your mission, right? From what you've
yeah,
been mentioning. Now, I just want to get your thoughts on something, which is like both you and I are in Canada, right? And to your point with
right,
your example, there's a lot of investors in Canada that are okay with or at least maybe not okay with, but they accept the fact that they might buy property that won't cash flow. Not saying that's a good approach, by the way, but they justify it by saying, well, it's gonna appreciate, right? It's gonna appreciate, and I'm betting on the appreciation side. So I want to get your thoughts on the fact that in a way, by looking at gross returns, like the 20% rule that you are referring to, is kind of like a gross return metric. um, are you are you indirectly just like going towards markets where property is going to be cheap, and could that be challenging from an appreciation perspective because it's not a primary market? It might be more of a secondary, tertiary market. So how do you consider for appreciation in your analysis, if at all?
one thing I want to mention there before I talk about the appreciation is you said, is it hard to operate because it's not a main core market? And the answer is no. Just and now, mind you, I'm not even on that side of the business.
Hmm.
Like there's a whole other side of people who are doing it, but the answer is no, just simply because there's still vacation markets that we're in. They're just not the main vacation markets,
Hmm.
and there's still a ton of people in those markets that need work,
Yeah, yeah,
right?
yeah.
And so even the small markets that we have, there's still vacation markets. And there's still people there that need to take care of those things. So even in the town that I'm in, there's only 2,000 people that live here, but I can still find cleaners, I can still find
Hmm.
handyman, I can still find all these people because
Hmm.
there's people that work here. So the answer is no, just to
Hmm.
that one.
Yeah.
But the other question really is, yes, you're asking about appreciation, right? Like, is appreciation taken into consideration when we're looking at into these markets? And I think it's more of a broader question that is a better way to look at it, which is like, is it a good real estate market to purchase in the first place, right?
Hmm.
So, if I'm going into this market, is it stable? Is it oversaturated? Is it overpriced? Like all of these different things kind of come into factor. And I would say that we have some markets that are better than others, right? But regardless, we are looking at the markets and we want to feel good and confident that the markets are going to be good and stable, right? It's the one thing that a lot of Airbnb people miss is just traditional real estate purchasing. Like so make like a lot of the long-term rental people have had to come up with a really creative ways of buying properties to
Mhm.
make sure that they have built-in equity with that property, so that if it does go down in value, they're still okay because there's zero cash flow really from these properties that they can expect, right?
Mhm.
And so they have to get super creative with it. Now, Airbnbs are different if you're strategic about it, because if you can find a cash flowing property and you're continuing to make cash flow from that property over the next 10 years, and you have zero plans of selling it because you did a cost segregation, then it really doesn't matter if the market takes a dip for the next 2 years, because it's likely to come back, right? Which is what we have seen in all
Mhm.
these markets. So the reality here is that are am I going into these markets and trying to find the absolute greatest deals that have the built-in equity, and we're adding, after we're adding things to the property to increase its after repair value and all that stuff? I'm not. I'm not, right? Like, I'm not focused in on that.
Mhm.
That's not my area of expertise. I strongly believe in it, especially if you have a really small portfolio and you're trying to build up on the real estate side. I think people need to get smarter about it, but that doesn't mean that we're buying stupid properties either.
Mhm.
We're very strict on what the basis is. Like, what are we actually buying this for? What is all the other things selling for? Do we actually believe that it'll appraise for that value? Do we don't pay for overappraised value? Like, simple things along those lines, right? But really, what we're going for here is we're saying, okay, this property is going to cash flow, and so then therefore, uh, we're going to hold it for the next 5 to 10 years. And
Mhm.
almost I don't think we have a single client that is planning on holding for less than 5 years at a minimum.
Mhm.
And so they can ride out any sort of wave because the property cash flows.
Mhm.
And if your property doesn't cash flow, right, you got to sell it as soon as that time comes. And so that's why I'm so crazy about the cash flow, or why I talk about the cash flow so much, is because it allows you to continue to hold on to that property and sell it when you want to sell it, which is sell it when it's the best time to sell it, right?
Mhm. Mhm.
And so the appreciation to me, it's not something that I'm sitting there going like, let's bank on appreciation. I go, let's bank on the money that you can actually put into your pocket.
Mhm.
Whatever happens, happens, right?
Mhm.
But again,
Mhm.
not trying to buy in like the dumbest markets you could buy in.
I
So
think that's a very good way to put it, because essentially, again, you're betting on the cash flow, and the cash flow allowing you to essentially be okay regardless of what happens with the market, also because you're looking at longer hold periods. I think what's important for people to understand is that there's those two elements of looking at a return, in an investment, is you can have cash flow and you can have growth. And oftentimes, I mean, in portfolio management theory, they talk about the fact that you can try to maximize one or the other, in a way, where
mhm.
that's why in markets like Canada, like, the growth element is oftentimes what's trying to be maximize growth from a point of view of being able to come in and, like you were saying, renovate and refinance and then buy more. But then you're not cash flowing, so you need to have the deep pockets to be able to
Yeah, I
service your
hate that.
debt.
I hate that. I genuinely hate it. I hate the idea of people coming in and saying, I'm okay if I break even or lose a little bit. And a lot of people do that in the States because of the STR tax loophole, where they
Hmm.
can buy the property and save on all their taxes. Like, I just saved $50,000 of taxes. I don't care if this loses $1,000 a month. They go, well, and in my head, I'm like, I get that. Yes, the maths, like, you're still ahead, but for how long are you going to be ahead? And then
Hmm.
when you have to eventually sell the property, you have to reinvest it into the next property, without, otherwise you're going to be paying those taxes right back, right? And so the dumbest goal that I see are people aiming to break even, right? They
Hmm.
go, I'm totally fine if this breaks even. I just want this to break even. I'm buying this property because I think it's just going to break even. That
Hmm.
is one of the dumbest things that you could possibly do, because you're probably going to miss that goal and you're probably going to lose money.
Hmm.
And sure, maybe find like, hey, I'm losing $1,000, maybe like $500 right now. When we hit the next recession, you are going to be losing your shirt, right? You're going to have to shut down that property. You're going to be losing way more than what you were thinking. Because if your property really isn't even that great in the first place, and we're in like a kind of a decent market right now, which is even insane to think, because we're so close to a recession, it's not even funny that when things come crashing down, you're gonna feel it like you won't believe, because you're barely making anything in a good times, right? So that's my like, I'm very passionate about that, because I want all my clients to be able to make it through the recession. And again, I come from the finance world. I did that for 3 years. I had to study all that stuff. It's going to happen. It's not an if and maybe, who knows, whatever, blah blah blah. It's going to happen. It is what it is, right? And so then therefore whoever's prepared for it will win. And if you buy things with that focus, like, okay, when this happens, what should we do, right? Even with your business or whatever it may be, if you're always just thinking about it's the worst case scenario isn't like the you have to redo the bathroom, or the worst case scenario is a flood. Like, that's not the worst case scenario. The worst case scenario is you lose during the recession, right?
And you
Because
end up
a
having to
lot
sell when
you
you're
sell
underwater, and
exactly,
worst timing ever to sell. Yeah, yeah, yeah. No, that makes sense. Let me
exactly.
get your thoughts
That's
on something, because I think you and I
yeah,
both agree on the fact that, first of all, a recession is coming, and also that it's important to prepare for it and not be just wishful thinking about it, but like actually know that
yeah,
you're running stress tests and making sure you're going to be fine even in the worst case scenario. So here's something that I've been having mental challenges with, which is the fact that with the approach that you're suggesting, which I get, trying to maximize for cash flow, you're trying to get that 20% gross return minimum. So inevitably you're going towards markets where properties are cheaper, right? Because you know
what do you define cheaper? Like, what's
well,
the price
cheaper
range?
cheaper cheaper than they would be in a primary market, where you probably wouldn't get the 20% that you are
Well,
aiming
we
for.
are like the majority of the majority of the properties we are purchasing are mainly between 500 and 900. They're
hmm
in that range. Would you
hmm
consider that cheap?
Well, cheaper than if you went to a city like
Parks. Okay. Okay.
yeah, yeah,
Okay.
yeah, yeah. So
Okay. Gotcha.
on the city, like on the core, downtown of a city, first of all, the regulations would make it tougher to operate it as an STR. Second of
Possible.
all, it probably wouldn't pass the 20% rule, because the properties would be too expensive for the revenue that they generate. But I do see one advantage, and I want to get your thoughts on how to hedge for this on your sort of investment approach, which is that if quote unquote shit hits the fan and there's a recession, like I do hear a lot of people talking about the idea of like, well, worst case I can rent as a midterm, worst case I can rent as a long term, worst case,
Hmm.
if there's no more
Yeah.
traveling demand, I have that hedge. How do you try to get a similar hedge when you're going into markets that are strictly sort of vacation rental uh, markets historically, and where you're getting very attractive numbers versus the
Yeah.
price points of the properties, but how do you hedge for that recession that you seem to be very aware of, the fact that it's going to come?
Yeah. So we hedge for it in a different way,
Mhm.
because the markets that you're referring to don't cash flow well, right? If it makes a great long-term rental, it usually doesn't make a great short-term rental. Those two just don't go together, because a great short-term rental is where there's a crazy amount of travel demand,
Mhm.
right? And you have good home prices. And if you're in a city, there may be some demand, but the home price is so high that it doesn't offset the demand, and you're in maybe a condo, and it just doesn't really make any sense, right?
Mhm.
And I have one market where we can meet both of those. That's it. Just one
Mhm.
that I've ever come across. Okay.
Gotta tell us what that
So
is.
nope. Not a chance. So I have to keep those things secret, just so you know, just because for the business, like, that's the work that we have
Of
spent
course,
a
of course, of
ridiculous amount
course.
of time and effort on. Yeah. So I apologize. A lot of people ask me that question, and I have to say no, just because it's the thing that we built our business around, is our research, right? So we hedge for the recession in a completely different way than what most people do, which is they get a place that has the ability to also like work out as a long-term rental, so, or midterm rental. So the way that I think about this is that when we hit a recession, it's not going to hit everyone the same. Now, it's mainly going to hit a ton of people, right? And a ton of people are not going to be able to travel. But there's still going to be people that are going to be able to travel. We even saw during COVID when everyone was told to not move,
Mm-hmm.
they traveled, right?
Yeah.
We saw in 2008 when people were losing their shirts left and right, people were buying houses left and right, right? And the reality is that some people will get hurt and some people will not, but the majority will get hurt. But people are going to keep traveling. They're going to keep going. They're going to keep using their money. And the way that I think about this is that if there were 1,000 people that were traveling to a specific market before,
Mm-hmm.
and now there's only 100, we just have to be one of those 100 homes that gets booked.
Mm-hmm.
And so the strategy is that we want every single last one of our clients to be in the top 10 percentile of the market that they're in. We want them to have the home that people desire to be in within that market so that when everything goes to shit and everyone starts lowering their prices to be able to get booked
Mm-hmm.
and we're lowering our price, right? We're now $100 for the night and then our next competitor is also $100 for the night. It's
Mm-hmm.
like a no-brainer, right? It would almost be
Mm-hmm.
like you looked at a Ferrari and a Honda Civic and you said, those are the same prices. Why would I not take the Ferrari, right?
Mm-hmm. Mm-hmm.
Because you're almost guaranteeing yourself that you're going to be able to get that booking for the very few people that are traveling there. Now it's a whole thing you have to like navigate around that I navigate in my head, such as this like concept of like, well, the top 10%, we have no idea how many people are actually going to be traveling when the COVID, when the recession hits. We have no idea what type of recession it's going to be.
Mm-hmm.
We have no idea of all these different little factors. And so the only thing that we can do is hedge our bets to be one of the best possible properties. But eventually you hit a limit of the number of people who could be the best possible properties. And you have to kind of walk away from that market and go, I don't feel comfortable putting anybody else into that market because if we do hit that recession, somebody's getting hurt, right? And it's going to be the guy with the lowest budget to be able to outfit the property. And so then eventually you have to go into another market and do the same thing, and another market and do the same thing. And so you have to keep doing this so that all of your clients are the top 10 percentile of every single market that they're in, and that when shit hits the fan, they're all okay. Like this is what I think about all day, every day. It's what keeps me up at night, right? And so we have sort of these like core markets that allow a lot of properties to go into there and to be the top 10 percentile. Like, as an example, one of the markets we're in has 35,000 listings.
Mm-hmm.
So it's going to take an outrageous amount of properties to, get out of that top 10 percentile. But we have other markets that have like 600. And so you can only get 60 in there max. That's not even the right number. 6. No, 60. 60 is the right number. Sorry. So you can get 6 properties in there max, and they would all be in that top 10 percentile. But still, there's other factors. There's other like luxury properties in the area and these kind of things. So I'm going into way too much detail here, but I'm just trying to explain to you that if you do go into market, you want to be the top 10 percentile. And I just want to state that every single property that we have put into the markets that is live and operating is in the top 10 percentile of their market, of their asset class.
Got it.
So we have been able to do that so far, and even the people that we work with, because our main I don't think I said we have services, right? But our main service is that we find people properties. I've kind of hinted at it a few times, but just be very direct. Like, if you had money and you wanted to hire me to find you a property, you can do that, right? And I'll point you in the direction of a property that you should purchase based off of your budget and your preferences.
Mm-hmm.
But we don't take on people that have under $150,000 because we don't believe that they're able to win in that market. And that's $150,000 of liquid money that they can put towards the down payment, the closing costs, the furniture, the reservation, renovations, the design, and everything else that they need to like get that property up and running, right? And
Mm-hmm.
if for even our like most affordable markets, right, where you can buy like $300,000 to $400,000 homes, we still need that amount of money just to be able to be in that top 10 percentile. Because I'm terrified of somebody losing their shirt over a decision I made. It
Mm-hmm.
scares the hell out of me. I don't want that. So
Mm-hmm. Mm-hmm. Got it. So basically, you're hedging by being the best in the market, and the reasoning there is like, if there's less, demand, well, you're not going to be the one that's affected, at least the first, right? So you're
even if they, I mean, everyone's revenue would be affected, right? Like, that's just kind of a given.
right.
But we want them to not be in a position where they have to sell.
Yeah.
And so the reality is like, we want them to be in a position where they're breaking even, right?
Mm-hmm.
Max, they're maybe losing a little bit, but the beauty about a recession is it resets, And right afterwards, it's the best time
Mm-hmm.
ever for everything.
Mm-hmm.
Always. People are like, "Oh no, 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 no," and then they make a few tweaks and everything goes great, and then it's the best time in the world, right? Like it's
Mm-hmm.
the best economy boom there is.
Mm-hmm.
And so the goal is to get them through the recession. If you can
Mm-hmm.
get through the recession, you're good. You're good for the next 5, 10 years, easy, right?
So
Because we get recessions
let's talk
every
about
8
that though.
years.
Getting through that recession, as in like what are some of the underwriting tips or best practices that you would suggest people put in place when it comes to running different scenarios, best case, worst case scenarios. So let's say you're running your numbers and the 20% rule works for a particular market. Um, you have properties that within the price point that you can afford, you know, gross at least 20% of that purchase price. Once you're actually looking at a deal, like how much should how much of a drop in revenue from what your best case scenario looks like are you usually considering?
It's an impossible exercise. It's waving a magic wand, right? The question you're asking me is like, how much is the revenue going to drop when we get into a
Not
recession?
how much is going to drop, but how much do you consider it to drop? Because you're saying as long as
Yeah.
it still cash flows, or as long as it breaks even in the worst case scenario, then
Yeah.
then we still want to go through. So how do you
So
determine in your analysis what that worst case scenario would be?
so we don't put in a recession scenario, but
Okay.
we put in a worst case scenario today,
Hmm.
right?
Hmm.
So when we do this, we go low, mid, high.
Hmm.
Is our We give three projections always. The low one, they should never hit the low one. If they do what they're supposed to do, they should not hit it. And if you look, we could provide all of the data to show them that if they just do what they're supposed to do, hitting the low would mean they effed up in some sort of way and it's on them, right?
And that's the one that breaks
Um,
even. That's the one that like.
no, no, no. That's the one where they make about $20,000 in free cash flow.
Okay.
So, yeah, most of our properties they're making anywhere from $20,000 to $70,000 in free cash flow,
Hmm.
right? And so if they f up, that's where they're going to land. Now, if they just do things how we expect them to do it, they're probably going to end up in the middle, right in that mid range. But if they exceed our expectations and they actually are amazing operators, they do everything well, they do an amazing job with the revenue and all this different stuff, and things kind of line up with them being really good at what they're supposed to do, that's where that best case scenario steps into play,
Hmm.
right?
Hmm.
So yeah, that's the idea.
Okay. Okay. Got it. Got it. So you're looking at it as worst case for today's circumstances, and looking
Yeah,
at numbers where even that worst case still leaves them with cash flow,
I,
essentially.
I call it a cushion. I call it a
A good
cushion.
cushion.
So
Okay.
yeah, so like in today, if you mess up, there's still a cushion there for error, right? And
Hmm.
that's the cash flow. That's $20,000 of free cash flow, which means you got to screw up by $20,000 to start to break even.
Hmm.
Okay,
Hmm.
and so the bigger that cushion, the better I sleep. Okay.
Yeah.
So the higher I can get them on that low end, I'm like, okay, if they really mess things up, right? They at least they're not losing money and they have to sell the property. That's
Hmm.
all that's the main thing. Like if they just don't listen to a word I say and screw up. Now that's mind you, that's self-managed. If you throw a property manager in there, they're gonna take, 20% of the total revenue, which is gonna throw those numbers off. It's gonna
Sure.
bring it a lot lower,
Okay.
which is frustrating, but they always have that option of booting out that manager and doing it themselves if they really needed to protect themselves because maybe that
Hmm.
something was going down, right? So,
Hmm.
um, anyways, yeah, that's
That
the
makes
idea
sense.
there. I
And
call it,
and the cushion, yes.
mm-hmm,
So
yeah, I
if
call
if
it the
I
cushion.
wanna if I wanna go in and try to put in practice everything that you have mentioned so far, and maybe I even go through, your courses and get more ideas, like where where do most people end up inevitably, making mistakes along that process that you're describing, where you really try to, pay
Yeah,
particular attention not to make those common
yeah,
mistakes?
that's a beautiful question, by the way. That is, I haven't been asked that one very often. So, and it's a good one because it hopefully anybody who hears this will be like, okay, I'll make sure to put that on my checklist
Hmm.
of like things to avoid, right? Because I have people who go through all of my stuff. right? They've gone through all the training, they've watched all my videos. I've got 200 plus videos on YouTube, right? Like they've gone through it and they still make mistakes. Okay. And I think the mistake that people make the most is, even if they've studied the market, they then find a property that they like the most, that fits their budget, that they think is going to win. Okay.
Mm-hmm.
Um, and they don't analyze it enough before they put the offer in. And this
Mm-hmm.
sounds so weird to say, because I believe these people are wholeheartedly reviewing that property as much as they possibly can, but they're somehow missing the little details. Okay. And what I mean by that is this, does the property have a second living room? Because you know that you need a game room in this market to win. You did all the research. You saw the top performers have a game room, and now you're going to buy a property that doesn't have a second living room. Like
Mm-hmm.
that scenario right there. I talked to a guy face to face at a conference, and I knew the market that he was in because I'm also in it, and I knew for a fact that the game room was without a doubt the most important thing because of the type of market. Without getting into the details, it was the most important thing, and he bought a property without that, without a second living room, so no game room. I was like, I'm like staring at his property on his phone, and all I can think in my head is like, oh my god, I think this guy just made a huge mistake, right?
Mm-hmm.
I hope I'm wrong. I hope I'm wrong. It was a bit of a unique property. Maybe you'll get that unique premium, whatever. But the reality was like he was missing the most important thing. And I even said that. I was kind of like, I'm like, oh, you don't have a game room, eh? And he was like, no, like he kind of hinted that he knew he should have had one, right? He was like, ah, yeah, like whatever. And so the reality is that the person made the mistake at the very last step, where
Mm-hmm.
they found a property, they liked the property, they met the requirements, but they just didn't look at the details enough. And another example of this is like the maybe they do get the one with the game room. It has a second living room, but it's too small. It can't
Mm-hmm.
even fit a pool table in there, right? It can barely fit anything in there. And so then therefore, you can't compete with these other game rooms that you're going up against. Or maybe it's got a backyard, but the backyard's too small. Or maybe the backyard's actually on a slope and you can't do anything there. Or maybe the deck is actually just too small. Or maybe the view is not good enough in comparison to the other views that you're going to be going up against. But because you fell in love with the property, you got so excited about that, you're like, oh, it's not even that big of a deal. It is a nice view. It is as good as that one. But in reality, it's not, right?
Mm-hmm.
And so it's a bit of this emotional uh game that happens where people actually get emotionally captured by the certain properties that they really have fallen in love with,
Mm-hmm.
and they will go, it's fine that the living room's not as big or the view's not as great as this other one. We'll make this property so great that it's going to perform just as well.
Mm-hmm.
And that's delusional. Like that's where that's not how it works, right? It's like saying, hey, if I put a spoiler on my Honda Civic, it's going to sell for the same as an F-150. And it's like that's never going to happen. No matter how much you make it look pretty, it's just not going to beat out the one F-150.
Mm-hmm.
And that's, that's just the reality of the Airbnb game. But that is the biggest mistake I think that people make is sort of twofold: emotionally getting connected and not reviewing every single last little aspect of that property to have the competitive advantages to make sure that they're going to be able to be in that top 10 percentile.
So if we want to help someone not make that mistake, basically like pre sending an offer, or pre closing on a property, whatever stage you want to be at. So you want to make sure that you have a clear understanding of what drives revenue for that market,
Yep.
and make sure that you have that in the property that you're acquiring, is what you're saying. So if what drives revenue is the game room, don't buy a property without a game room, right?
Very straightforward.
That's one. And then of course, that, well, that you talked about the 20% rule. That one I think we've touched on quite a few times. What how would you complete that checklist of, things not to forget, double checking, triple checking, confirming, about the numbers, about the assumptions, about like
Mm-hmm.
whatever, prior to
Mm-hmm.
closing.
I mean, yeah, I think you said it in the answer. You said checklist, right? Like maybe you just have a checklist of when I analyze the market and figure out what the revenue drivers are, I bring it all together and summarize it, and I call it a buy box. And I go, I'm going to buy something that meets all these requirements, right? And then therefore when I go to look for a property, I have a list of things that I need in the backyard and in the interior. And so then therefore if the property does not meet all those requirements, I don't move forward with it, right?
Hmm. Hmm.
That's a pretty straightforward
So
way to do it.
you pre-identify the checklist. You build the checklist once you're at the stage of analyzing the market, and then you just
Yep.
have to refer back to that checklist you did when analyzing the market. Make sure all of that is ticked. Okay, makes
Yep.
sense. Question
Exactly.
for you, John. Your model. Did you build your own sort of data scraping mechanism and whatnot, or are you more so like helping people leverage the existing data platforms out there and make the most out of them?
Leveraging the existing ones.
Okay. Okay.
Yep. Yep.
Got it. Got it.
So I just use AirDNA.
Hmm.
Yeah.
Hmm.
That's all.
And one of the things that I'm sure you must have seen a lot when it comes to looking at data is you see properties that seem like they generate a lot, but then I'm sure you
Mhm.
must have ways to go into the details and identify that there's red flags that basically tell me that I shouldn't believe these numbers. You mind talking about what some of those red flags might be to not believe the numbers of a certain property on, let's say, an RDNA?
Yep. So the main thing, what you're asking here, is the difference between what I refer to as good data, data that you can use to make decisions with,
Hmm.
and useless data. I used to call it bad data, but I got in trouble, and so I
Hmm.
call it useless data now. I had the one of the head guys at AirDNA call me up and go, "Yeah, you can't be doing that." And I was like, "Okay, fine, sounds good." And I actually did a podcast with him yesterday. He's a great guy. Love Jamie. Um, so it's good data is what you're looking for. Okay. There's a bunch of data within the AirDNA platform and every other platform that exists out there that is not useful. And so useful data, what you're looking for is a full-time host that has had their data, their Airbnb calendar tracked for almost a full year. Okay.
Hmm.
So if you're on AirDNA, there's a number that's sitting there that says days available. That really should say days tracked. Okay. What that means is how many days has the AirDNA algorithm been recording the calendar of that specific Airbnb. And
Hmm.
if it's been recorded for 30 days, it's going to show you what it believes the revenue to be over 30 days. And then you can't take that number and just times it by 12 because it's always going to be off in their seasonality. And even when AirDNA tries to predict what it'll do over a full year, it's never really that accurate. So I don't like using that. Okay.
Hmm.
But there's other properties that have been tracked or days available for almost 365 days. And so I like to see
Hmm.
my properties that I'm going to be analyzing to have at least been tracked for over 250 days. At a minimum, it's over 250 days. I feel a little bit more comfortable with that. It's only missing about 3 months. I know what those next 3 months are going to be. Are they peak
Hmm.
season, low season? And then I can justify the revenue estimate that AirDNA is giving. Okay. And so that's the first thing is just how many days has it been tracked by the algorithm. The next thing is you want to make sure you're looking at a full-time host because there are a lot of part-time hosts. And when you have a part-time host in the AirDNA algorithm, it tends to screw up quite a bit
Hmm.
because it can't. The hard thing to do is trying to determine if it's a booking or a blocked day by the owner, right?
Hmm.
And so then instead, you got to try to identify if it's a full-time host and just ignore everybody else. And the way that I do that is I like to see a review every single month for the past 12 months, ideally
Hmm.
1 to 3 reviews for the past 12 months. If I can see that, I know that that's a full-time host, that they're not renting it out themselves hardly at all. And even if they
Hmm.
rented it out for a week, it's not a big deal because if AirDNA calculated that as revenue, it technically would be revenue if they didn't stay there. And so if you buy it and you don't stay there, that's revenue, right? So, anyways, I'm going into too much detail on that. But what I'm just trying to say here is good data is it's been tracked for over 250 days and it has a review every single month for the past 12 months. If you can get both of those things, you're most likely looking at good data. The last requirement, which I've almost never talked about, but I'm going to just mention it here because I
Hmm.
feel like I need to mention this more often,
Love it.
is is that let's say that you followed that process and then you found 10 Airbnbs that all pass that requirement that are in your market that you want to study. And you have them in order from who's making the most to who's making the least. So you got some people doing over 200,000 all the way down to people doing 100,000. Well, you should logically There should be a logical story from top to bottom. Okay. So as you're looking at each individual listing and you go from the one that's making the most to the one that's making the least, they should continually getting worse and worse. Either smaller homes, not as well designed, not as many as amenities, whatever it is, but they should continue to get worse. And if there is for some reason a really shitty listing that's at the very top that doesn't make any logical sense, there's something wrong with the data, even though it passed our test. And so, and therefore, you got to remove it, right? And it's as simple as that. So, yeah,
That's great.
that's the yeah. I do apologize. I just checked the time and I realized that I actually have another call in 1 minute.
Yeah. Okay, we'll wrap it up. And
So,
hey, thank you so
yeah,
much, John, for your time. Really appreciate you being here. Where can people connect and stay in touch? Check out your courses and whatnot.
yeah. So you can find all of my courses on strsearch.com. strsearch.com. That is the main website to go to be able to find all of that. And there's just going to be a link up there that says free courses. And then if you go through those courses and you realize like, hey, I don't have the time to do this, or I want to hire John or John's team to be able to help me find a property or analyze a property or whatever it may be, we have those services there for you. And you can just, either schedule a call or go ahead and order one of those. But I appreciate you having me on here, man. This
Thank you
is
so much,
awesome.
John. It was great to have you.
I really
We'll stay in
appreciated
touch.
the conversation.
Talk soon.
Yeah. See ya.